Good day, Financial Accounting in Full students, and welcome to lesson 72. In this lesson, I'm going to explain to you the cash flow statement, and also I'm going to explain to you how to draw it up and all the principles regarding a cash flow statement. Okay, a cash flow statement forms part of the financial statements of a business. All right, you know that you have already done an income statement and a balance sheet. Now those two are drawn up at the end of the financial period. You know, an income statement is, you draw up an income statement to determine whether the business made a profit or a loss, and then what the profit or the loss was. And then the balance sheet is drawn up to determine what the financial position of the business is on that last day of the accounting period. All right. Now, in addition to that, we draw up a cash flow statement. So a cash flow statement also forms part of the financial statements of a business. The reason why we draw up a cash flow statement is we want to determine what the inflow and outflow of cash was. As the word says, cash flow statement. So in that statement, we will determine what the inflow and outflow of cash was. In other words, we're going to see for what did we spend money during the year, during the accounting period. Have we spent, on what did we spend the money? And on the other side, what was the source of income for the business? How did we make the money? What type of money came in, how we made the money, and how we spent the money. So that is the purpose of a cash flow statement, is to determine what the inflow and outflow of the cash was. The users of a cash flow statement who are interested, why would we do a cash flow statement? The first person or the first party who's interested in a cash flow statement is the owner. The owner wants to know what was the inflow of money in his business and what was the outflow of money out of his business, because he wants to determine, I'm sure you've heard the word, the cash flow situation. He wants to know what his cash flow is. Will he be in a position to pay his creditors? What is nobody that's got a business, or even no person, wants to be in a position where you can't pay your debts. Or if you can't pay what's necessary to pay, or if you can't pay your debts. So therefore, it's very important for a business to have an idea of what the cash flow position of the business is. The other parties that are interested in the cash flow of the business, the first one is a creditor. A creditor is, you know what a creditor is. A creditor is a business or someone that you owe money. So normally when you buy goods on credit, you buy it from a creditor. Now the creditor wants to know, will this business be in a position to pay pay back his debt? So the creditor will be interested in the cash flow of a business, as well as a bank. Maybe the business is in a position that the business wants to make a loan from the bank. Then obviously the bank will be interested to know, will that business be in a position to pay back the debt? So those are the parties that are interested in the cash flow statement. All right, just to give you a brief description of concepts in the cash flow statements. Remember, when we worked with the income statement, we worked with income and expenses. All right, income and expenses, you all know that we also had something like prepaid expenses or accrued income. So in other words, it was like we received money, but it was actually applicable for the next year. It wasn't for this year. Or we could have had, or we had accrued income. I'm just taking that as an example. So accrued income means it's an income that you were supposed to receive, but you haven't received it yet. So that is an accrued income. And those income, accrued expenses, prepaid expenses, all those are entered, under current assets and current liabilities. Because let me just give you that one example of prepaid expenses. You paid water and electricity, for instance, for the next financial year. You've paid 1 month's water and electricity in advance. All right. What's the double entry? The double entry is you debit prepaid expenses and you credit the expense account. In other words, what you actually do is you make an adjustment on that expense account. All right. And the adjustment is done by that double entry, which I just said, and that prepaid expenses, you will enter that under trade and other receivables. Remember, if you think of your balance sheet, under trade and other receivables, you will have debtors, and then you will also have prepaid expenses. All right. So what it is actually means is that you want to know what the actual cash was that you paid for an expense, or what was the actual cash that you received for an income. All right. And to adjust those accounts, we are going to work with current assets and current liabilities, trade and other receivables, trade and other payables. We are going to use those current assets and current liability accounts to adjust our income and expenses accounts, because we want to know what the cash was regarding that income and expense. Let's take another example. Your sales. You know the amount that you enter in your income statement for sales is your total sales. In other words, it is your credit sales and it is your cash sales. In the cash flow statement, you're not interested in your credit sales. You're just interested in your cash sales, because you work with cash, the cash flow, inflow and outflow of cash. So what we are going to do is in that we will have to adjust or to do a correction in the sales account. How are we going to do that? I'm just giving that brief introduction. We're going to take our total sales, and then we will take out the credit sales out of that, just to get the total sales. And the credit sales do, what is the double entry for credit sales? Credit sales, debit, debtors. Okay, so if we take our debtors, which is appear under trade receivables, if we can deduct that from our sales, we can get closer to the cash sales. Other two things that has got an effect on the cash sales, for instance, is our discount allowed and bad debts. If we remember in the sales, I just spoke about this, the credit sales. All right. Now people pay their debts. Now we allow them discount. We don't receive that full amount for the sales. Let's say the original sales amount was you sold goods for 1,000 rand. Okay, you allowed 100 rand discount. You don't receive 1,000 rand, you only receive 900 rand. Okay, so we also need to take out that discount from the sales to get to the actual cash sales. The same with bad debts. Remember, we sold goods and then we sold it to the debtor, and then the debtor can't pay his debt, and then we write off the amount as bad debts. Debit, bad debts, credit, the debtor. And then it means that, but that amount was originally entered under sales, because it was originally entered under credit sales. But now we haven't received that money because it's debt that's been written off. So what we need to do is we're also going to take out the bad debts out of the sales. But we will get to that a bit later.